Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, July 16th, 2024. Hope you're having a fantastical day out there. I'm not having a good day. I got stuck with jury duty. Yay. And I got a trial I got to be on the rest of the week. So, damn it. Anyways, so if anyone needs anything from me, just shoot me an email, send me a voicemail, whatever you need to do. I'll take care of it after hours or before I head to the courthouse each morning. So looks like it's going to be a 3-day trial. So Wednesday, Thursday, Friday. So it screwed up the rest of my week. So I'm in a good mood, but I will do my broadcast at the end of the day. So maybe a little later, like 5, 6 o'clock Mountain Time, by the time I get a chance to read through everything and get back and put together a presentation. So anyways, hope you're having a good day. And if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All righty, let's go ahead and get into today's numbers. Dow Jones, big day. I mean, I was sitting there in court watching the markets. And I'm like, wow, it was crazy. Dow was up 1.85% today, 742 points. Now, granted, 700 points sounds huge, but I mean, 15 years ago when I was a wet behind the ears advisor, that would have been monstrous. But granted, the Dow back then was like 20. So anyways, all right. S&P 500 was up 0.64%. It was in the red most of the morning, up 35 points, closed at 56.67. NASDAQ up 0.21%. It was also in the red most of the day, up 0.21%, 38 points, closed at 18,510. And I think I missed this. The Dow closed at 49.54. So I think the big thing is that, let me shrink that down. I think a big thing is that a lot of people are probably moving their assets from growth like tech and things like that and are starting to move back towards the blue chips, which is why we see the big rally in the Dow. Again, this is just my personal observation, just from looking at this from 30,000 foot view. But that's just kind of how the way it looks, from up high. So, all right, let's get back to the rest of the indexes. VIX says it's flat. It's at 1319 right now. Canada up 1.07%, Brazil down 0.19, and Mexico up 0.12. Germany down 0.39%, the UK down 0.22%, France down 1.87%, Netherlands down 1.21%, Spain down 0.47%, Italy down 0.02%, Switzerland down 0.09%, and Portugal down 0.53%. Russian exchanges back in the green today. The MOEX up 1.14%, the RTSI up 0.6%. And the Asian markets, the Nikkei was up 0.22%, Australia down 0.23%, New Zealand up 0.38%. In China, the Shanghai was up 0.08%, the Shenzhen Component up 0.86%, China 50 up 0.1%, DJ Shanghai up 0.25%, Hang Seng down 1.6%, and the Taiwan weighted up 0.49%. All righty, so good stuff. All righty, let's get to the market recap and see what happened there. Dow delivers best day in more than a year on stronger earnings. The Dow had the best day in over a year on Tuesday, closing at a fresh record high. This surge was driven by better than expected retail sales data and a series of mostly positive quarterly earnings reports from major corporations. U.S. retail sales were unchanged in June on a monthly basis, following an upwardly revised 0.3% gain in May. This was better than the expected 0.3% decline, indicating robust consumer spending. The strong consumer activity suggests that the Federal Reserve might be limited in how aggressively it can cut rates, as reducing rates too quickly could overstimulate the economy. Where have we seen that happen? Oh, wait, 4 summers ago. Stifel noted that even if the Fed considers rate cuts as early as Q3, the action might be limited, tempering investors' hopes for substantial cuts. According to the CME's FedWatch, traders now see an 89% chance of a 25 basis point cut in September, with a small chance of 50 basis points or 0.5% cut off of the federal funds rate. I wouldn't hold my breath, folks. All right. In the corporate earnings world, quarterly earnings reports were a significant driver of market optimism. Bank of America surged 5% after exceeding expectations in second quarter revenue and profit, driven by higher investment banking and asset management fees. Morgan Stanley rebounded from earlier losses to close 1% higher after reporting better than expected results. However, Charles Schwab dropped 10% as it hinted pausing buybacks to manage debt and reported a net interest margin below estimates. United Health Group, a major Dow component, jumped 6% after surpassing quarter two expectations, despite some challenges in its Medicaid business. All right. Match Group saw a 7% rise following news that activist investor Starboard had acquired a 6.5% stake and was pushing for potential sale options if a turnaround wasn't achieved. Conversely, Reddit Inc. fell 3% after Loop Capital downgraded its rating, citing valuation concerns. Trump Media and Technology Group dropped 9%, pulling back after a 31% surge the previous day amid the broader market rally. Political uncertainty from the assassination attempt on former President Donald J. Trump at a Pennsylvania rally over the weekend had little impact on the market. Trump, officially nominated as the Republican frontrunner for the 2024 presidential race, named Ohio Senator J.D. Vance as his vice presidential running mate. The assassination attempt was seen as potentially boosting Trump's chances of victory, which could signal a loser regulatory environment. I'm not sure why. Overall, the market's strong performance was underpinned by positive economic data and corporate earnings, despite the political backdrop. I mean, I can see if they blew his head off that the markets would be in chaos, because there'd probably be chaos across the country. But, thank our lucky stars that didn't happen. Just nicked his ear. Unfortunately, there was a fireman behind him that did not come out of it so lucky. So not a good thing, folks. But anyways. All right, let's get into some sales data, retail sales, June retail sales numbers. And this comes to us via First Trust. And this was put together by economic analyst Nate Gersey. So let's see what Nate had to say here. In June, U.S. retail sales were unchanged from the previous month, closing out the second quarter on a weak note. However, sales data from prior months were revised upward, painting a slightly more positive picture. Retail sales increased only 2.3% compared to the previous year. June's stagnation was partly due to a 2.3% drop in sales at auto dealerships, likely influenced by cyber attacks on dealerships. I don't remember that in the news, but I could be wrong. This drop could lead to a rebound in pent-up sales in July. Excluding auto sales, retail sales rose by 0.4% in June. The report showed that 10 out of 13 major categories saw sales increases in June, with non-store retailers, including internet and mail order, leading with a 1.9% jump. Conversely, sales at gas stations declined due to falling gas prices. When excluding gas, autos, and building materials, core sales, which are crucial for GDP estimates, rose 0.7% in June and 1.2% when including the revisions. Core sales increased at an annualized rate of 3.4% in the second quarter compared to a 0.7% pace in the first quarter. Sales at restaurants and bars, representing the only services sector in the retail sales report, rose by 0.3% in June, with previous month's data significantly revised upwards. The initial reported 0.4% decline in May was revised to a 0.4% gain. Boy, that's almost a 1% shift. Including revisions, these sales are up 1.3% in June. Overall, retail sales have not kept up with inflation, with a 2.3% increase over the past year. Inflation-adjusted retail sales have decreased by 0.9% over the past year and have remained stagnant since peaking in April of 2021. This trend aligns with the view of a slowing U.S. economy, as the effects of the drop in the M2 money supply, which we talked about yesterday, from early 2022 through late 2023 to take hold. Additionally, the Empire State Index, which measures New York's factory sentiment, declined to a negative 6.6 in July from negative 6 in June. On the trade front, import prices were unchanged in June, while export prices declined 0.5%. Over the past year, import prices have increased by 1.6%, while export prices have risen by 0.7%. All right, so a lot of data there. Good stuff. So it looks like things are just kind of meh right now. So it's not too hot, not too cold, but unfortunately, prices are still way too high. They have not. We've not seen any deflation in prices at all across the board. All right, last up, an article from Zero Hedge. This one titled "Fed Rate Cuts: A Signal to Sell Stocks and Buy Bonds?" And this was written by Lance Roberts via RealInvestmentAdvice.com. So let's see what Lance has to say here. With economic and inflation data showing signs of weakness, expectations for Federal Reserve rate cuts are rising. Following a weaker than expected consumer price index report, the odds of a quarter of a percent rate cut by September have increased to 90%. The market has repeatedly rallied on hopes of Fed cuts since January of 22, although each rally eventually failed as economic data kept the Federal Reserve on hold. Recent economic indicators suggest that the Fed is nearing the point where rate cuts are warranted. Federal Reserve Chairman Jerome Powell's testimony before Congress reinforced this notion, highlighting a cooling labor market and suggesting that further softening might be undesirable. Consequently, financial markets reached new highs, driven by the expectations that stocks would rally when the Fed eases financial conditions, a trend observed since 2008. However, we covered an article last week that talks about the bottom usually comes after Fed starts raising rates again. Oh, I'm sorry, cutting rates. And so, you could, and we covered this, that the bottoms were all, typically, 90 to 360 days after the first rate cut. So we'll see if, will it be like the trend since 2008, or will it be more like the longer term trend where, in going back historically over the last 100 years or so, that, falls in line more with that. So, we shall see, folks. However, historical data indicates that the Fed rate cuts are not necessarily bullish for the market. Since 1970, significant rate cuts have typically coincided with economic downturns or financial crises, leading to average market drawdowns of 27.25% from the start of the rate cut period to the market trough. So from right here, so let's just assume, let's go down from the Dow at 40 right now, where it's at. So to go down 25%, we would have to get down to about 30. So, duh. Quarter of 4 is 1. Duh. I'm an idiot. So you get what I'm saying. All right, let's get that off the screen. Up. Here we go. All right. Oops. Where'd my article go? There it is. All righty. We're back at it. This suggests that investors should be cautious about expecting a continued market rally with the onset of rate cuts. Rate cuts usually occur as the Fed attempts to counter disinflationary economic cycles or financial events leading to reduced consumer activity and declining corporate earnings. This scenario necessitates a repricing of current market valuations, despite analysts' optimistic earnings growth projections for 2025. A Fed rate cutting cycle is likely to disappoint these expectations due to economic realities. One asset class that stands out during Fed rate cutting cycles is Treasury bonds, as they benefit from the flight to safety during disinflationary events, economic recessions, and credit-related events. Historically, Treasury bonds have shown a high correlation with Federal Reserve rate changes. As the Fed cuts rates in response to economic conditions, longer-term yields adjust accordingly, making Treasury bonds a potential safe harbor for investors. As the first rate cut in September approaches, again, let's not get too far ahead. As the potential first rate cut in September approaches, it may be prudent for investors to consider reducing risk equity and increasing exposure to Treasury bonds, which could perform better than stocks during this period. All right, so that is everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. That's where all my contact information is. So you could send me an email. You could even draft a letter, and my address is there too. You could put a stamp on it and everything. I got stamps right here. You could send me a letter, and I could send you a letter back, just like the old days. Anyways, all right. Well, I hope everyone has a wonderful evening, and I shall talk to you guys again next time. Like I said at the beginning of the broadcast, it'll be probably late tomorrow and through the rest of the week because of my jury service, because I got to be a good citizen and pretend to care about this type of crap. I'm sorry. Anyways, all right. Like I said, I hope everyone has a good night, and I'll talk to you later. Adios.